Right, so we've got a Tortoise Capital looking at the weekend reports for 2012 with the connection and all, and see what we're at. We've got it's back in bullish quiet conditions on an annual basis. It's at 65 out of 100 on Williams, or I'm sorry, on a weekly RSI 1410 index. It's flat. We close next. The percent stress average up to 7.4. That's healthy. Still, the slope of the 50 is now green 20%, so that's been getting stronger, and that's a more adaptive measure than the 200-day stretch. So the fact that it turns green first is not surprising, but that's a good thing. ADX is up to 18.5, and they were below last week, so that's a good thing as well. So we're seeing some evidence of improvements across the board on the technical measures. ATR percentage is now down below 1.0. It's at 3%. That's why we're in the quiet zone. And that's exactly half of what it was about 4 weeks ago. Stability is quite remarkable. When it was at 1.6, this would sell off at the 200-day moving average. That was of the recent volatility spike. Climbing out of that hole, the market has gotten significantly more quiet. 20 portfolio for blended monthly is still holding a treasury ETF. It's treasuries, real estate, and the large caps. Exposure is at 100%, remains at 100% exposed. A quick look. What's far and fast TLT has moved out of contention. It's now in the ETF cash position. And if you look at the 26, and only two are on cash, the Swiss franc and the treasuries. Meanwhile, it's the on back up Australia. I've seen an awful lot in the press about dividend chasers or dividend payers, and Australian banks tend to be prominently positioned inside of international dividend payers. You can buy those. It's about 45 to 48% Australian ETF is composed of their financial sector. So that's a way to get exposure to Australian banks and some of the diversity of their market. But notice B and Asia less Japan are now above S&P on the 13, and energy and agriculture in the 26. So there's a slight change in guard as we see your way north. M is in position 14, MDY is in position 16. So we're starting to see a move towards the risk and away from the U.S. here. And that, one of two things: either we're at the U.S. is at the top of its cyclic phase and is getting ready to rotate to other winners, or people are filled with such confidence because of the strength in the U.S. that are willing to take gains outside. I think it's still some more of the first. I still think the election is sitting like a big fat cow on top of really runaways in the U.S. markets. I don't see how there's a runaway market until a decision about it. And that's just because of the the difference in policies that each presents. Health check. Here we go. Vertical blue line 20 and of look back period. Horizontal purple line that was just reached at 142. Finally, we're looking at that during February of this year, and we finally got our close above 142. And now we'll get to see whether that holds. It's a little hammer doji at the top, but you can also see there is now compared to size of the candles back then when it was seeing the 200-day moving average. So a little bit with the market's down. So bull quiet. You can see ADX that coming down from 35 down low 50. It's now just starting to creep back above. It's at 18, crossing over theirs. Bull firmly in charge. This is a positive technical sign. But the fact that it can be pointing up and still have a low ADX means that there's still room for it to go. Less choppiness in evidence in the last 10 days compared to 30 and 40. Heck, even the 50 and 60 too. Just a much straight. The regression is the center black line. The outer black line is a regression channel formed by maximum excursion from that region line. You can see the price has been out of the river for 10 days, 11 days. The river is at 30 period Bollinger Band with 1 standard deviation. Period moving averages out of the river. That's favorable. There's a poor man's regression line cross system is, when the 30 period regression line comes out of the river, it's the equivalent of the RLCO beginning of trending behavior. And so that happened back on 23 July. Line emerged from the river, and so that's been very positive. So everything looks good there. The slope of the 50s get better, and it almost left the 50 behind. That's how different it was when times were bad down here in late June, when the field near the top of the river. Now it's a favorable sign short term. You can see that we've left the 5 and the 10% pullback areas completely. Now we're up into no resistance overhead until you look back 4 years. Next really is 150. There's resistance until 150. I see that really as the upper limit of what's available until November, and the sort of resolves itself. But in the meantime, it's, still good news. It's been oversold for a period of time now. The jaw PPO have been remained open for almost 3 weeks. That's been a reliable early signal. Seeing if it can hold above 142, but that is tentatively the new support level. Failure here comes back into the river at 140, and then down to about 135 at the bottom of the river is really, the point of support. I would even say the bottom of the regression channel and the mean at about 138-ish. That's what I would take as the first start. If this 142 fails, would be 138. So that's 4 points. That's 3%. So that's the downside. Upside be 150. So I think it's so favorable now that it's just above 142. That is. All right. All regions of the world are now coming in on. And what's interesting to note is the Asia less Japan and NASDAQ are both on the strength. It's the first one to change, right? And that's the most sensitive. And the fact that those are green shows clearly where the strength. And so this could be a passing of a guard from the large caps at 53 to the NASDAQ at 57 on the average rating. And you see it's still even stronger on strength rating. So that's very favorable for the risk on trade. Moving on. And so we have strength returning to the U.S. led by the NASDAQ, and everything's above average except for this little anomaly here of the mid cap. That's strength in the U.S. right there. Even the European region is benefiting. Asia less Japan, led by real strength in Singapore, Malaysia, but now Australia, and their strong financial sector. All the regions suppressed. U.S. real estate. Only Brazil is lagging in the Latin American markets. Lag. In the business sectors, now you can see everything is above average while all the currencies and the commodities are getting crushed. Technology has leaped up. So that's sort of the gateway towards improvements in these other business sectors. And so the defensive plays are starting to step aside as a little more confidence gets into the market. Base. And it's really the same leaders as before. Home construction had a night this week with a state, X, telecom, staples, select. Although you can see the strength starting to come out of that. When its strength turned right, that's just that run is starting to cool off. It's con trade on. And it's starting to enter. They've been strong for very long because their quality number is so high. When their strength starts to go, then that is a shift away from. You see down here these immediate term bonds. That's all a sign of creeping weakness. Green in the column and in the column. That's to erode. And average followed. That's an increasing technology. Are strength leaders in that sense. That's a way to chart. A little. You can see what's in the intermediate these ones TFI, but the strength in technology, Singapore, Mexico are some of gaining strength. The way to enter. Move on. Show interest to you because it's green in strength and white on the average score, and means it's been volatile but gaining strength. You can see Pfizer starting to weaken. That's one of your defensive plays. It's starting to fail. J. Morgan, United Tech, in the second column of the strength column, starting to overcome the weakness in the other area, so a sign of improvement. Those are two companies in the down and rise. Now moving on. We're going to just move up to the regression line crossover in the river. Just taking a look at 4 assets. I'm really starting to like this layout, and so I am probably going to expand the number of asset classes to look at. But for right now, this gives a pretty interesting read into market conditions. What you'll notice is that SPY is the regression line in 10 period. Its 30 and 10 period regression lines have left the river pointing up, and price is actually above 140. You can see that the small cap are mirroring the move. They get choppier, and the 30 just crossed the Bollinger Band mean. That's the black line has just crossed the Bollinger Band. It's still in the river, but when river line crosses the Bollinger Band mean, did back here, that is generally, I'm taking that as a sign that the intermediate trend is changing, and so I take this as a very positive sign. The small caps, that as this comes along, there's room for caps. Interestingly, it's not failing. A series of higher lows, and the river has turned, and both have left the river. I think that's a stealth play on QE3. Headers buying gold while still suppressed and has failed to fail further. 150 was a really powerful support. That's 1,500, and so at the sign of which in SPY, watch for a nice bounce in gold. That's a very interesting triangle. Treasuries, which have been leading the way, you can just see how they have gotten crushed in the last couple. That's the alleged risk-free rate return, I suppose. But now the 30 has crossed the Bollinger Band mean. Both the regressions are out of the river and failing. And that could be a sign of treasuries, have cracked. So upside is definitely indicated on this chart. The gold does intrigue me, however. We're going to leap ahead now to the daily. I won't repeat the top row. Now this is interesting here. When we take a look at the gap over the last 30 days, right? The market's gapped down 13 times in the last 10 of the 13 times. The gap down is reversed to close higher for an average follow through of 0.33. That's the morning hook in play. That's still the way to play it. It's the higher percentage, and it has a bigger follow through compared with the gap down and fail further. So that's a pretty remarkable result. It's been 3 times likely, and it's paid off 3-2. Conversely, on the gap up, you can see 17 times, but a coin flip. 9 times the gap up has reversed to close lower. 8 times the gap up has continued through and relatively close. Is how I read that, is until otherwise otherwise indicated. You can see, looking at the last 10 days of the NDX, we are still overbought and have been that for a while. No signals in the channel overreacted. And really, to look at the difference between this, just how narrow this quiet range has been. Only 70 cents from the pit to the S3 level. That's staggering. Looking at volatility indicator, just how much volatility has pulled out. It's as quiet as it has been in the last 100 days. You can see AX has crossed the bears and is now playing catch-up. Handling an overreaction, we do have some signals in the broader indexes and in a bunch of the large caps. And the auto framer has hit McDonald's, Coca-Cola, and real estate, all things that you want to own. And natural gas and treasuries are very interesting. I started trading the triple leveraged treasury ETF for the first time last week, and I'll try and talk through one of those trades. It actually was a pretty nice couple are. Up the Dow 30 tactical summary. Quite a few channelings, quite a few doji formations. but only one that beats the auto reward to risk. Not surprising, the market is closed, at 100 on its NDX, so there's really not much room to the 10-day high because most of these things have closed right at or near their 10-day high. What's kind of cool here is the RSI rating on some defensive plays. Kraft, Johnson & Johnson, and Merck, all at less than 10 on their RSI. So that's one I know Mark will be looking at too. Only XLU in the ETFs has closed below 10 on its RSI too. And again, that could be, and when you look at that and those defensive plays in the Dow, that could simply be people that have been making the defense plays, that have been leading the way for the last 6 months, just cashing in over the last couple of days and looking to start repositioning. That would be consistent with the price action that we're seeing. Quite a few Gs again because of the narrow range. That's not surprising. Treasuries and utilities on a channeling. Treasuries on a overreaction. The reason I was interested in treasuries as a trade with max pain range compression and the fact that there's one on the auto framer, I mean, you have to like that. That's the risk-free rate of return for them, 5% in the last days. So that's 2 years worth of interest payments that it lost in capital on the last 5 or 10 days. Moving on. Looking at the market mosaic here. The regression line pretty tight. And you can see the doji action of the last couple days. The regression line pulling away from its end period moving average here on the last 180 days is just getting to 1 deviation up. And you can see that on the zoom in here in the southwest corner. And the percent stretch of 200 after that little scare down here in June and the oscillations is starting to vote upwards, and this could be a resurgence of strength here as it cut out of this choppy action here. And so we just look at the recent swing high, looking at a move of about 7 or 8%, and that's fully consistent with that challenging the 150 before November. So again, I think that's the maximum reasonable target that I can see in the upside. So I think this is still a trader's market, but the choppiness of these past 3 months has got to be a concern. Looking at the Z-scores of 3 regression lines, the 10, the 30, and the 90, these are all favorable. The 90 has crossed the 0 line, so it's positive, and it's got a long room to run compared to where it was at the last swing high. The 30 has just left the region, plus or minus 1 normal, so there's room for it to go higher, although that's a pretty good, kind of a remarkable move. To me, the easier move has already been made, and you can see how choppy the 10 has been. But again, if it finds support here and goes up, we can see another mad rush up like we did earlier this year, and that's what would get us up to 150. So if the 90-day regression line can get out of this yellow zone of normal, then that's what it would take to get price up to 150. So that's the upper limit. Take a quick look at the holdings. Just do a quick look at where we are with this market. If we look at 40-day hold periods, all of the primary indexes are below 1.0. So that's healthy. There's no runaway exaggerated. The 20-day periods are all fairly close to 1.0. So the 20-day swing trade is fully valued. The 10 and 5 really, are not exceptional, and so what that does is they're still for that 50% move without triggering any kind of irrational exuberance declines yet, right? I mean, even the emerging markets are even slightly below water on the Z-score. So nothing overheated in this market. So with the low ADX and the low Z-scores on these holding periods, I take that as plenty of room to allow for another 8% to the upside, technical trading. So this is a very positive position to be in for swing trades. There's no resistance overhead and reasonable room to go. All right, let's see if we can't find some, just a couple trades in the treasuries from last week. Let's do a couple quick case studies here. Okay, while I'm waiting for these other charts to load up, has the sound been okay? Cool. I think I must have just had too many windows open. When I shut everything else down, it seemed to get better. I got a new rig coming in from Digital Storm Online. There's some guys that I've used before to get good desktop and laptop solutions. I really like the setups they got. One coming with 30 gigs of RAM, or 32 megs of RAM, and a great big monster processor. New toys. Yeah, it's called digitalstormonline.com, and I've been it's a small shop out in California, but I'm very pleased with their tech support and standing behind their product. I've had 2 laptop and a desktop with them. I'm very satisfied with their specs. All right, let's see if we can't get one here. It's taking a long time to load, sorry. While we're waiting, I made Bundle 3 for TradeStation is shipping now for the blended monthly rebalancing. I always think it's kind of cool I can get Bill Broward to say, wow. You know, after 20 years of programming in TradeStation, what I can get him to just sit up and take this and actually to start using my strategy for retirement accounts, I feel like an accomplishment. Got it. Yeah, some greetings. Oh, finally, here we go. I added out this great blank silent space. Sorry. Okay, so this was now I have not been trading treasuries, but something about the way it went from the river, and when the 30 period crossed the ball, kind of a fell off. I still looked at this here, and this was on and so these are 30 charts looking at the last 10 days. And I'm using that standard regression line crossover lens. And you can see this pronounced downward move. This is in TMF, and this is 3 times leverage on TLT. This is the long bund, if you will. And so I look at this one as the previous day had failed to filter. It got down to about 70.5 and then closed around 7.5. And then in the morning, opened up and started going up and crossed its own VWAP. So what I decided to do here was enter at 72 with a very stop. And then what I was looking at was a return to about 73 to this resistance level, this congestion zone. And then this congestion zone at about 76.5 and then 8.25. This congestion zone, and then the top of this sideways channel here in this congestion at 8.1. So I looked at even, a third cent didn't have to be that close. like a minute chart if you see. And so we have LCO signal at about 70.87, and now price in the 10-period regression line at the river. And so I would say the far side of the river, I've been really happy. So an entry at about 70, 72 even is the entry. And so we can find here. Okay, then on this next chart, back to my 370 here and about a 0.3 initial stop. And then what we get is price leave river on 3 period, and it was well out. 30-period regression was well outside. Then when we leave, we'll take 72 even, and it moves up out of the river consistently up to 90. So about 3R in hand. Excuse me. Nothing about taking an exit here once it crosses back into the river. I would have cashed it if it had come all the way back to the Bollinger Band support. And then I looked at the yellow zone about 3 ounces to break out from here, but it never did. So as 30-period regression line turned back into the river, I just decided, when the run is done, I'm going to go ahead and take my exit at 72.80, and that's about 2.5 hours for about a 90-minute trade in the Treasuries, and that's that case study. I have been in Treasuries traded, so it's reasonable, and as long as it has that 6.5 to 1 reward to risk, then I'm interested in TMF, especially if we break down. Get the narrowing daily ranges and extreme quietude of SPY at 42. It doesn't go up to 150 from here. Instead, it starts pulling back. That's going to look like an attractive alternative once more, and people will look at that as a buy on dip opportunity and trust, and that'll be an easy decision for them to make, in my view. So that's why I'm kind of interested in the. Let's see if we can find. Yeah, here's one. We'll look at this one. This is yes. That's strange. I'm going to go ahead and stop it there, and we'll try it out all. I think it's a really powerful. I mean, it lets you do things that ETF just simply can't do, and it's at price less than 2 years annual subscription at ETF Replay. ETF is a great site. I mean, you're wrong, but it limits you to only ETFs and only lets you go back to 2003, and you can only have 25 ETFs in the bundle in your portfolio. But the package that Bill Brower's put together lets you mix stocks, ETFs, and mutual funds. You're not limited to 20 in the portfolio. You can vary the look-back period. You can use trailing stops. You can use profit, outsized profit targets. You can have parabolic moves. You can put other exit strategies. It will run the back test as far back as the sources have data. So you can look at stocks on these kinds of strategies much faster. And you get the full range of the trade back testing routes in order to fund a little bit. I just think it's a really powerful package, and it's going to. I think that was going to make me a TradeStation user just because of the ease for back testing. So I'll alert you to that possibility. So thanks for hanging in there. I'm going to stop recording on this and hung on YouTube. So take good care, and we'll see you in the chat room.